Welcome back to Market on Close. I'm Marley Caden. The passage of the Genius Act recently has brought stablecoins front and center and upped our conversations about cryptocurrencies and how they function. So to discuss more about stablecoins and specifically how they could play an important role in moderating the U.S. debt situation here in America, I'd like to welcome in our next guest, Scott Melker, the market analyst and host of Wolf of All Streets. Scott, thank you for being with us. We appreciate you taking the time. I guess first question is, why should someone invest in stablecoins right now?
Well, there aren't really that many ways to invest in stablecoins as a retail investor, which has been probably frustrating for the crypto industry, as it's clearly been one of the killer apps for blockchain technology. That's why we saw the Circle IPO do so exceptionally well, because there was this incredible pent-up demand to have access to an investment in that space and really no way to do it before. Most people who buy stablecoins are doing so to actually use them, to make micropayments around the world, to speculate on crypto assets, to trade tokenized stocks. There's quite a few reasons to have stablecoins, but unless you're doing it in a yield-bearing manner, it's not really an investment. It's more of a tool for all of the activities that you want to do.
And what kind of stablecoins are the most attractive right now, would you say?
Well, very clearly, the fully backed stablecoins are the ones with the most demand. We have Tether, which is the largest in the world, has a market cap of about $167 billion and rising rapidly. Of course, there's Circle's USDC, which is more of a US-based but also fully backed stablecoin. Once you go beyond that style of stablecoin, we can go down a very deep rabbit hole of different ways of earning yield. But there's a lot of hesitancy, I would say, in those markets because of the blowups that we saw in the past with things like Luna and others that were confused as stablecoins and were not, but they were called algorithmic stablecoins, which caused quite a bit of confusion. But the ones that are primarily being used are USDT, aka Tether, and USDC.
So with USDT, Tether's USDT, they have this new strategy where they're integrating USDT natively on the Bitcoin network. What are your thoughts on that? And also, what does that mean more broadly for the crypto space on the whole?
I think it's a very clear signal that stablecoins are a commodity, right? We've seen a lot of good and bad takes about what stablecoins mean for different chains. Obviously, Tron and Ethereum have the bulk of stablecoins right now. Them coming to Bitcoin just means that you'll be able to use the Bitcoin network for basically using stablecoins. It's not really that huge of news. It just shows that stablecoins are so popular that they're going to be cross-chain, interoperable all over the crypto ecosystem and beyond. So we also see news like Circle launching their own layer 1 blockchain for their stablecoin. That's really interesting because that becomes less decentralized and really gives them more control of the way that stablecoin is used and how they can make income on it rather than doing it on a public network.
And so I want to come back to the Genius Act. You mentioned some of the blow-ups and some of the potential risks that have been associated previously with stablecoin. But Genius Act how important did that become in terms of stablecoin adoption and usage and, I guess, feeling less risk in buying stablecoin?
Yeah, I think that the Genius Act is causing a Cambrian explosion in development of stablecoins, usage, adoption. There were so many people sitting on the sidelines that knew that this was a superior technology, faster, cheaper, easier, no third party to pay a toll to in the middle of your transactions. But they needed that regulatory clarity to do it. And I'm talking about the biggest institutions in the world. I mean, we have Western Union saying they're going to create their own stablecoin, the Citibanks, PNCs, Goldman Sachs, JP Morgan, all of them talking about either adopting an existing stablecoin or building their own on private networks. So I would say that now the confidence to use this superior technology is there and nobody's afraid to do it anymore. And it really is just that much better.
So I want to move now to what I talked about when I was introducing you about the possibility of stablecoin helping to moderate the U.S. debt situation, which is certainly going to come into play as Congress returns, from vacation and we try to avoid a government shutdown here. What kind of role is stablecoin going to play?
Absolutely huge. It's possible that stablecoin issuers will end up being in the top 3 buyers of U.S. Treasuries in the next year. I believe that last year, Tether alone was the 6th largest, and writ large, they're over as a holder, they're in the top 10. So stablecoin demand drives Treasury demand. This is the new secret weapon for U.S. debt demand in a world where obviously we're seeing a lot of countries try to distance themselves from the dollar, from the U.S., trying to sell off U.S. debt. You have this nonstop bid underneath stablecoins as they increase. And every time a stablecoin is minted, a dollar is put into a treasury to back it. So we're effectively just distributing treasuries all over the world every time a stablecoin is used.
And so for an emerging market user, like someone who might not directly buy a treasury, there is still a possibility of them supporting U.S. debt through stablecoin adoption.
That's right. They don't know that they're buying a treasury, but the stablecoin that they're using is backed by a dollar worth of a U.S. treasury, usually a short-term duration treasury that can be obviously easily sold very quickly if one of these issuers need liquidity. And that really is the killer use case right now, is micropayments between people all over the world. I mean, imagine trying to send $5 to your friend in Zimbabwe. It's effectively impossible. You can't do it with a bank account. It would get frozen. There's different networks. SWIFT is slow. The fee would be more than you're actually sending. I can send you a stable coin anywhere in the world for effectively no money instantaneously without a third party checking on that. And you have to think about how many places in the world people are extremely thirsty for dollars. They'll go on the black market, pay 3 times the rate to get physical U.S. cash, and then they'll go put it in a safety deposit box because of the hyperinflation of their own currency. None of that exists anymore. Anyone in the world at any time can get a dollar for its actual value and transact and hold it themselves in self-custody. It's mind-blowing how powerful this idea is for people around the world.
And I guess I want to close out, Scott, with just asking you about the potential risks of stablecoin adoption.
I don't think that there's tremendous risk if you're using one of the large issuers that's fully audited and fully backed. I mean, when you talk about a Tether or a USDC, I mean, these are companies that are fully audited. They have Cantor Fitzgerald sits on the board of USDT, Howard Lutnick himself, who's the Commerce Secretary. So I don't think there's much risk actually with those stable coins at all. I think the risk will be when you start to get foreign stable coins that don't really comply with the Genius Act, that may be taking on risk to earn yield or backing themselves with something other than short-term duration U.S. Treasuries and cash, debt from an emerging nation or something like that. But those are not going to gain any popularity anymore now that everybody has a safe option to go to. So I think those are really risks of the past that don't exist anymore.
Well, Scott, we appreciate you breaking all of that down for us. Certainly stablecoin and crypto has been so top of mind with the passage of this new legislation and some new legislation likely on the way as well. That's Scott Melker, market analyst and host of The Wolf of All Streets.